Why does the market crash at its most optimistic peak and rebound at its most pessimistic trough? This global bestseller, written by Howard Marks, the memo king of investing, unveils the secrets behind market fluctuations. It's not a dry finance textbook but a guide with 20 investment principles to decode the patterns of cycles, the nature of risk, and the flaws of human behavior. Why did Warren Buffett call mastering the market cycle a must-read? Let's dive into Mark's investment world to discover how to seize opportunities amid market ups and downs. Howard Marks' journey, from intuition to cycle mastery. Howard Marks, founder of Oaktree Capital, is a revered Wall Street investor known for his calm mind and deep insights. His career began in the 1970s as a bond analyst at Citibank, leading to the creation of Oaktree Capital, managing billions in assets. Mark's success wasn't instant. It stemmed from a profound understanding of market cycles. Mastering the market cycle distills his 40 years of experience into 20 core principles, revealing the foundation of investment success. Influenced by Benjamin Graham, Marks embraced the concept of a margin of safety from the intelligent investor. Unlike Graham's focus on buying cheap, Marks emphasizes the dynamic shifts of market cycles. In the 1987 stock market crash, he avoided major losses by reducing exposure to risky bonds, learning that investing is about timing the market's rhythm. The 2008 financial crisis was another turning point. Marks warned clients of subprime risks through his memos and boldly bought distressed assets at the market's bottom, earning billions for Oaktree. Buffett once said Marks' memos are a must-read for their unique perspective on markets. Marks' success lies in his keen sense of cycles. Markets swing between optimism and pessimism, with opportunities hiding where most fail to look. His journey shows that great investors aren't fortune tellers but observers who master the art of probability, risk, and human nature. The nature of cycles, the market's pendulum, and human behavior. Why do markets constantly fluctuate? Marks argues that market cycles are driven by human emotions amplified in economic activity. Investor sentiment swings between greed and fear, pushing prices away from intrinsic value, creating booms and busts. Take the 2008 financial crisis. Marks dissects how the subprime market cycle led to collapse. In the early 2000s, low interest rates and loose credit fueled a housing boom, with optimism about subprime derivatives inflating asset prices. Defaults rose, sentiment flipped to panic, triggering a price plunge. Marks notes this cycle wasn't random but driven by a chain of excessive optimism ignoring risk, excessive pessimism. Economist Robert Shiller, in Irrational Exuberance, echoes this, pointing to collective emotional frenzy as a bubble's root. Marks' analysis aligns closely. Another example is the 2000 dot-com bubble. Tech stock mania doubled the Nasdaq in 1999 to 2000, despite many companies lacking profits, fueled by new economy hype. Marks recalls his team avoided overvalued tech stocks, opting for undervalued bonds in traditional sectors, dodging the bubble's burst. This counter-cyclical thinking is Marks' core philosophy. Risk peaks in extreme optimism, and opportunity emerges in extreme pessimism. Cycles aren't limited to financial markets. Marks' pendulum theory likens markets to a pendulum, swinging between extremes, never resting at a reasonable midpoint. This swing stems from human greed and fear, and successful investors stay clear-headed when the pendulum strays. As Marks writes, market cycles aren't your enemy but your teacher. Psychological biases, the investor's hidden traps. Why do smart people make market mistakes? Marks believes failure often stems not from lack of knowledge but from psychological biases. The human brain seeks patterns and follows crowds, which can be deadly in investing. First bias is confirmation bias. Investors focus on information supporting their views, ignoring contrary signals. In 7, many fund managers dismissed early subprime default warnings, blinded by the belief that housing prices always rise. Psychologist Daniel Kahneman, in Thinking, Fast and Slow, notes confirmation bias comes from the brain's fast system seeking simplicity. Marks' observations align. He advises seeking opposing evidence, like reviewing decisions with the question, "What if I'm wrong?" The second bias is the herd effect. In market frenzies, investors follow the crowd, fearing they'll miss out. In the late 1990s, clients questioned Marks for avoiding tech stocks, warning he'd regret missing the rally. Sticking to his principles, Marks avoided the frenzy, knowing herd mania signals risk. He quotes Buffett, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian mindset helped him buy quality assets after the 2000 crash. The third bias is overconfidence. Many investors overestimate their ability to predict market tops or bottoms. Marks cites the 1998 collapse of long-term capital management, a hedge fund led by Nobel laureates, and done by overconfident mathematical models. He stresses that acknowledging uncertainty is the starting point for success, focusing on risk management over prediction. These biases show that investing is as much a mental battle as a technical one. Marks' insights reveal that to beat the market, you must first conquer yourself. The art of risk, the core of cycles. For Marks, investing isn't about chasing returns but managing risk. Mastering the market cycle defines risk as the uncertainty of future outcomes, with cycles as its source. How do you control risk in cycles? Marks offers 3 principles: recognize risk, assess risk, and manage risk. Recognizing risk is step 1. Risk isn't just market declines, it hides in seemingly safe boom times. In 2006, low subprime default rates misled investors into thinking risk was gone, but Marks' analysis of loan data revealed a hidden default chain. His memo warned, "Risk is highest when no one is afraid." Ray Dalio's principles discusses risk parallax, where exuberance underestimates risk and gloom overstates it. Marks' view aligns. Assessing risk is step 2. Marks advocates probabilistic thinking over gut instinct. In 2003, Oaktree evaluated a distressed bond investment, estimating a 60% recovery probability and 40% loss risk, leading to a profitable decision. This mirrors Bayesian reasoning, updating risk judgments with data and logic. Managing risk is step 3. Marks' defensive investing includes diversification, maintaining liquidity, and setting a margin of safety. In 2008, holding cash and short-term bonds gave Oaktree flexibility to buy at the market's bottom. Buffett's 2008 Goldman Sachs investment, using preferred stock and warrants, balanced risk and upside similarly. Risk management is the soul of cycle investing. Marks sums it up: you can't control returns, but you can control risk. The Cycle Toolkit, practical strategies for investors. How do you find opportunities in cycles? Marks provides a toolkit to stay rational and seize chances amid market swings. First tool: contrarian investing. When market sentiment hits extremes, it's often the best time to act. In 2008, Marks bought distressed assets at the crisis's bottom as prices fell below intrinsic value. Similarly, Buffett invested in Bank of America during 2008's panic. Marks suggests watching sentiment indicators like media tone or fund flows. When sentiment is one-sided, contrarian moves pay off. Second tool: cycle positioning. Knowing where the market stands in its cycle is key. Marks 3: is the market overvalued or undervalued? What's driving it? How might it evolve? In 2020's COVID crash, Marks analyzed Fed policy and corporate cash flows, identifying a market bottom and buying tech and healthcare stocks. He advises tracking indicators like interest rates, unemployment, and valuations to gauge cycle stages. Third tool: dynamic adjustment. Marks rejects static portfolios, advocating position shifts based on cycles. In the late 1990s, he cut tech stock exposure and leaned into high-yield bonds, avoiding the dot-com crash. This requires discipline, like setting clear buy or sell rules to avoid emotional decisions. Fourth tool: long-term focus. Cycles are short-term. Wealth comes from holding quality assets long-term. Marks cites Coca-Cola's stable cash flow and brand power, enduring multiple cycles. Buffett's 1988 Coca-Cola investment, still held today, proves this. Marx urges focusing on intrinsic value over price swings. These tools, rooted in cycle and human nature insights, aren't complex but demand discipline. Cycle lessons, from investing to life. Mastering the market cycle offers wisdom beyond investing, reflecting life's ups and downs. Cycles mirror human nature, and Marx principles apply broadly. First, cycles teach us to embrace uncertainty. Markets, like life, are unpredictable. Marx learned from early losses not to predict precisely but to manage risk. Psychologist Carol Dweck's mindset advocates a growth mindset, adapting to change. Marx's approach resonates. Second, cycles teach patience. In 2008, Marx waited months to buy at the bottom, observing carefully. Ray Dalio's principles emphasizes delayed gratification for long-term goals, echoing Marx's patience. Third, cycles highlight intrinsic value. Marx writes, "Price is what others set, value is what you find." In investing, he focuses on business fundamentals. In life, this means pursuing your own goals, not others' expectations. Apple's Joanna Hoffman chose passion over trends, becoming a design pioneer. Marx's cycle theory is a philosophy for navigating both markets and life, applying cycle wisdom in the real world. How can Marx's ideas be applied practically? Here are tips for investors and everyday people. First, develop cycle awareness. Whether investing or working, track the pendulum's position. In overheated industries, risk rises. In overlooked ones, opportunities emerge. In 2023, China's EV boom led some to chase highs, but disciplined investors bought during pullbacks for better returns. Second, manage emotions. Emotions amplify cycles and cloud judgment. Keep an emotion journal to reflect on decisions and check for greed or fear. London real estate investor James Carter sold properties in 2020's COVID panic, later realizing fear drove his choice. He now pauses to ask, is this rational or emotional? Third, build a safety net. Marx's margin of safety applies to life. Keep 6-12 months of emergency savings for financial cycle lows. Buffett's 2008 cash reserves ensured flexibility, a model for personal finance. Fourth, adopt a long-term view. Short-term swings don't define success. Focus on core strengths. LinkedIn's Reid Hoffman built expertise in tech over finance fads, creating a global platform. Marx's wisdom helps us face uncertainty with confidence. The broader cycle, reflecting economy and society. Market cycles mirror broader economic and social trends. Marx's cases reveal how technology, policy, and psychology shape cycles. The 2008 crisis, fueled by low rates and lax regulation, grew from a housing boom to a global recession. Joseph Stiglitz's Globalization and its Discontents notes policy errors amplify cycles. Marx agrees, stressing macro context in decisions. In 2020's COVID crash, Fed stimulus rapidly lifted markets, altering cycle rhythms. Marx noted investors must track central bank moves, as China's 2020 stimulus also sparked asset bubbles. Social psychology drives cycles too. In the 2000 dot-com bubble, media and public frenzy inflated tech valuations. Sociologist Robert Merton's self-fulfilling prophecy explains how belief shapes outcomes. Marx's contrarianism counters this. Cycles are a dance of markets, policy, and society, and Marx's insights simplify the complexity, limits, and breakthroughs of cycle theory. Marx's theory, while brilliant, has limits. First, cycles are unpredictable. Despite warning of subprime risks, Marx couldn't pinpoint 2008's crash timing. Economist Eugene Fama's efficient market hypothesis suggests short-term prediction is futile. Marx focuses on long-term trends instead. Second, cycle analysis demands data expertise. Marx's 2003 bond investments relied on deep financial analysis, often beyond retail investors' reach. He suggests index funds or ETFs to simplify cycle investing. Third, cultural and market differences matter. Marx's US-based experience may not fully apply elsewhere, like China, where government policies heavily shape cycles. Ray Dalio's Big Debt Crises stresses understanding local cycle drivers. Despite limits, Marx' contrarian and risk-focused principles are universal, offering breakthroughs in any market. The future of cycles, evolving investments and society. Where is cycle theory headed? Marx' ideas remain relevant for future challenges. Technology, like AI and big data, is reshaping cycles. Algorithmic and high-frequency trading amplify market swings, as Marx notes in recent memos. Morgan Stanley's 2023 AI-driven market sentiment analysis predicted tech stock corrections. ESG investing is also shifting cycle drivers. Marx sees sustainability extending certain sectors' cycles, like renewable energy in the global net zero push. Norway's sovereign wealth fund's green energy bets reflect this. Cycles also have societal impact. In 2020, global stimulus mirrored Marx' counter-cyclical approach to stabilize economies. Economist Paul Krugman's The Return of Depression Economics advocates counter-cyclical policy, aligning with Marx. Cycle theory bridges investing and societal challenges, offering wisdom for wealth and resilience. Conclusion: the light of cycle wisdom. Mastering the market cycle is more than an investment classic, it's a mirror of human nature. Howard Marks' 40 years of experience show that market and life fluctuations are inevitable, but understanding cycles, managing risk, and controlling emotions unlock opportunities. As Marx writes, you can't change the cycle, but you can change how you respond to it. From 2008's crisis to 2020's pandemic, cycles reflect the interplay of human nature and environment. Successful investors and wise individuals stay calm amid swings, finding certainty in uncertainty. This book teaches not just how to invest but how to navigate life. It reminds us that cycles are both challenges and teachers. Risks are both traps and opportunities. Whether you're an investor, professional, or everyday person, pause and ask, how will I face the cycle before me? The answer may shine through as you turn the pages of Mastering the Market Cycle. Follow Mark's path to uncover your own light of wisdom in the world of cycles.